So, MPW has cut the dividend. Is it time to panic? Is it time to reassess? Is it time to average down? I know that there's a lot of people doing each of these things. There are some people that are just getting out, there are some people that are just getting in, and there are some people who are averaging down. So, the stock price, surprisingly, did not move much today. In fact, it went up slightly based upon this news and one other bit of news that came out over the weekend. So, MPW on Friday took a huge dump because there was this Wall Street Journal article that came out basically implying that their investment deal with one of their tenants, Prospect, was being held up by California regulators. Now, I took that at face value and sort of wrote it off as California regulators being California regulators. I have a bone to pick with the California government to begin with, because of some of the ways that they've targeted different companies like Walgreens, for example. But, I wasn't really shaken by it. It seemed like they were just being a nuisance more than anything else. But management for MPW actually responded. And this is funny. I had joked with a friend that something about that article and the timing of the news coming out about the California regulators just rubbed me a little bit the wrong way. Like, it was intended in a way that wasn't just merely to inform. And it's funny reading now MPW management's response to that. They actually had spoken to, or rather engaged with, so it may have been like emails or something like that. The article writer Jonathan Wheel, I don't know if I'm pronouncing that correctly, sorry, to give their transparency and their side of the story, basically, as to what was going on with the California Department of Managed Healthcare. Try saying that 10 times fast. And MPW and their investment in Prospect. So their investment in PHP Holdings LLC is being examined by this regulatory body in California. But it is a standard, expected, and non-controversial part of the approval process for the transaction. Now, I, just like most other people who first read the Wall Street Journal article on Friday, probably didn't know that, right? Yeah, I certainly didn't know that this was standard and expected because I'm not an expert on these type of transactions, nor is the average investor. So the fact of the matter is, though, that the scummy thing is that they apparently, according to this, seem to have conveyed this to the author of that article, and that part, as far as I know, was nowhere to be found. So that's interesting. It's almost like they set out when they wrote that article to only tell one side of the story. Journalism at its peak. So, the hold simply indicates certain additional information is required prior to the issuance of the final approval. The company fully expects to obtain that in due course. And even if it does not in the end get approved, the investment would remain a convertible note with identical economics and equity, identical economics to equity ownership. The convertible note thing, I think, means that it stays debt that, theoretically could be converted to equity at some point in the future, but they would get paid interest, etc. And so, anyway, as a result, the request, the DMHC, the California government, their request for that information was deemed immaterial to the financials and thus did not require disclosure. So that's why I guess it didn't really get brought up on the earnings call, because it's a normal thing for the transaction and would not materially affect the financials. Makes sense. So the other thing here, and this one's actually pretty important, is that the company's recording of $68 million worth of equity as revenue for the second quarter was fully consistent with accounting requirements. Yeah, that $68 million has to be reported somewhere, and for that to be recorded, even though it's not cash, as a revenue, if they're gaining from it, right, seems like that would be consistent with accounting. Now, here's part of the issue, I think, right? So when the non-cash items appear in the financials, making it look like the dividend is more well covered than maybe it is, which certainly, if you look at their normalized FFO and adjusted FFO, it looks like they have a lot more buffer there for the dividend than they really do in cash terms, which is why, to an extent, I think they didn't really want to talk about the dividend on the earnings call, because they probably were having a conversation behind closed doors about maybe cutting it at that time, but they weren't ready to make the final announcement yet. So that brings us to the dividend cut. So they trimmed it from 29 cents a share to 15 cents a share. And to be honest, while this is a slight disappointment, as a shareholder, to not be getting the same dividend that you were getting, but it improves the payout ratio massively and gives them a lot more wiggle room to improve their cash position, to either pay down some debts or have more room to pay slightly higher interest rates in the future if they have to do some refinancing, or to make other deals happen that could be accretive to shareholders. You have a lot more maneuverability as a business if you have more cash to play with. And, they've stated that the goal with this is to improve the balance sheet. Now, when I first started investing in MPW, the cake was the balance sheet, okay? I was looking at the $14 per share tangible book value, and that was really what I was salivating over. Now, the dividend, I think, was a nice bonus, a nice, call it a cherry on top. So what has happened from my perspective as an investor is they shrunk the cherry so that they can hopefully make the cake bigger and better. So while I'm disappointed because I really like cherries, right, I can live with this. Hope that analogy helps. Now, they've declared a quarterly cash dividend of 15 cents per share. So it's almost a 50% dividend cut here. They've carefully considered the dilutive effects of recent and pending dispositions, recapitalization transactions. So, for example, they sold off their Australian hospitals, and they've been doing some different things like that, making some maneuvers with some of their tenant investments and that sort of thing. Divesting the Utah hospitals from Steward, and then getting a different tenant in place to kind of reduce their exposure. So they're pursuing additional transactions to reinforce asset values. Okay, that makes sense. So basically, they're trying to improve the balance sheet. And of course, reducing costs is another objective that they've stated here. And I don't know really where they specifically think they can cut those costs, but yeah, that would be super helpful if they could. But they want to basically grow or improve the balance sheet at the expense of the cherry. help the cake at the expense of the cherry on top. I can live with that. I think that it's probably the smarter move for the business. It's echoes of Intel, really. Everybody was, basically catastrophizing Intel's potential need to cut the dividend. They did it, and initially there was, some sell-offs and stuff that happened from people that were holding on just for the dividend. But in the time since, the market has realized that in the long run, if it's good for the underlying business, if it's good for Intel as a company to have that extra cash to be able to do what they need to do, to deleverage or not take on as much debt, to pay things down, etc. I think, all in all, that this is probably a similar situation where it's a better move for the business overall, rather than them just barely, scraping together the cash to pay out their really high dividend. It's better if they reduce it for a while, get their cash situation sorted out, do what they need to do with their debt and with their assets. They have a lot more maneuvering room to play around with now, and I look forward to seeing what they do with it. That's about all I got for you on this one. Take it easy, everyone, and remember, it's just another Manic Monday. Cheers.